So today we're going to be looking at chapter 19 and that homework assignment. This is, in my opinion, the longest homework assignment out of probably this class and the first accounting course. For that reason, it will very likely be broken into two videos. The first covering problems 1 through 7, the second covering the remaining 7 problems. So do be prepared. I don't intend necessarily for you to watch the entire thing. Just kind of find, if you are struggling on a problem, where that is, because it's going to take us a while to kind of walk through these. So I'm going to try to make it as quick as possible, but do be aware this one is going to be rather lengthy. So we're starting off here on the first question. Trio Company reports the following information for the current year. Notice it's their first year of operations. That's good information. It tells us that there's no beginning inventory sitting around. There's nothing that's still here from last period. So that's a good piece of information for us. And what they ask us to do is pretty simple. They say, hey, come on in here and compute the product cost per unit under both absorption costing. Under just absorption costing. I do apologize. I thought this one had us doing it both ways, but it does look like we're just doing this with absorption. So the first thing that we have to understand is whenever we're using absorption costing is essentially looking at all of the costs associated with the production of this unit. So that includes direct materials, of course, direct labor. And that also includes variable overhead and then fixed overhead per unit. So 3 of those numbers, the 12, the 15, and the 3, we just pull straight out of the table above. So we can certainly see that. So let's just highlight where that's coming from. So we see this 12, the 15, and the 3, of course, just coming straight from our table up top. But the question is, I don't see a 6 anywhere. So where did that 6 come from? Right? That's the real question, is how did they get that? So to get the 6, what you have to do is you have to allocate that fixed overhead on a per unit basis. So what we're going to do is we're going to take our fixed overhead in total, $135,000 per year. And then we will, of course, divide that by my units that were actually produced this year, 22,500. And when I do that, the $6 pops right out. So that is where this $6 actually comes from, is this calculation here. So with that done, we can now see that what we have is $36 as our cost per unit of finished goods. And now the only thing left to do is to actually do the remaining 2 computations. First, what is the total cost of finished goods inventory? So all we do is we're going to look and we say, all right, there are 6,000 units in finished goods inventory. So we'll take the 6,000 units times the cost per unit of $36. And that 36 times 6,000 is $216,000. We'll then repeat this process for cost of goods sold by simply taking the units that were sold, 16,500 times my cost per unit of $36, and that will give us a total here for $594,000. So with that, we have officially finished question number 1. Now, moving on to question number 2, it's very similar, but you'll notice here we're computing inventory costs under variable costing. So Trio Company reports the following information, et cetera, but now we're using variable. So what we notice with variable costing is that whenever I'm actually computing that cost per unit of finished goods, I'm not including the fixed overhead component. Right? Under absorption costing, fixed overhead was considered part of the cost per unit. Under variable costing, it is not. So in this case, what we're going to do is we're going to grab our information that we were given, the $6 here, the $7, and the $2. That'll all simply drop straight in like so. Adding all of that up, we come out to a cost per unit of $15. And so now the only thing left is to do what we did on the last question. So we'll simply come in, find my number of units that are still in finished goods, 9,600. So that comes in here, times my $15, and that gives me 144,000. And then of course, I'll find my number of units in cost of goods sold, 29,000. And then I'll simply multiply that by the 15. And so that gives me 435,000. Now, it is worth noting, I referred to this as cost of goods sold on accident. Truthfully, under variable costing, we will just refer to this as the units that were sold, right? So be a little bit careful there. We see cost of goods sold under absorption. It's an actual account. Under variable costing, we do not actually see the account labeled cost of goods sold. So do keep that in mind. A little bit of a slip there on my end, but don't let that mess you up. Now, going into number 3, we're looking at Sims Company. They're a manufacturer of tablet computers. They began operations 1/1/19. We have their cost and sales information below. So just glancing at what we're doing, looks like we're going to prepare a variable costing income statement and then an absorption costing income statement. And we'll notice that our net income is not the same under the two methods, right? So just before we even do anything, just be aware, right? There are times when my net income will be different depending on if I'm using absorption costing or variable costing. Very good. So in this case, we will take off with our variable costing here on number 3. So what I'm going to recommend is go ahead and, if you want, just take a snapshot on your phone of this information if you want, so you can follow along a little bit easier. Just so we don't have so much just constantly going up and down, I'll just be referring back to the numbers as I need to. We may go back up once or twice, but I'm going to try to limit that just to keep it from bouncing so much. And so we're just going to pretty much stay down here where we need to be. So first thing that we have to realize is we are preparing a variable costing income statement, which is going to look different. It's going to be structured differently than the absorption costing income statement. And the absorption costing income statement is very, very similar to the structure that we had back in 2301 whenever we prepared our original income statement. We have all the main components that we had back then. We have sales. On that, of course, we have cost of goods sold. We have gross margin. All those various topics that we covered in 2301 are seen on the absorption income statement that we'll get to in just a second. But the variable costing income statement is set up totally different, right? So we've got to be careful. We've got to keep those two completely separate in our minds, and then that will allow us to do this correctly. So first things first, we start off with sales. Of course, in this case, to get my sales, I'm simply going to take the number of units that were sold, 75,000, times my $360 per unit, and there's my $27 million in sales. So that's our first line, right? So just like under absorption, that top line is going to be sales. So the very beginning is the same, right? We always start with sales. It's just the stuff that's after that that changes a little bit. So under variable costing, the first thing that we want to take out is my variable cost. So that's where we're going to start. So sales minus variable costs, and in this case, we can find that we have direct materials, in this case, of $3 million. And you say, well, where did that $3 million come from? Well, that $3 million is because we sold 75,000 units and we had direct materials of $40 per unit. So simply multiplying these two numbers together will give you 3 million. We'll come down, we'll do the same thing for labor. So 75,000 units times $60 per unit, and that's 4.5 million. And then we'll take our 75,000 units times our $40 per unit in variable overhead. And so that will simply come in right here. And then our variable selling and admin, they actually just gave us right there, 725. So we've now grouped all of our variable costs together, totaling that section up, these four numbers. This will give us $11,225,000. At this point, we will simply subtract the $11,225,000 from the $27 million, and this will give us contribution margin of $15,775,000. Now you'll notice that initial subtraction here gives us contribution margin, but under absorption costing, that initial subtraction that we do at the top of my income statement actually gives us gross margin or gross profit, right? So do be aware, and we can see that if we just flip over. Right, here's gross margin after that initial subtraction of sales minus cost of goods sold gives us gross margin under absorption, but under variable, that initial subtraction of sales minus variable cost, that gives us contribution margin. All right, so be very, very careful as you study this chapter. Be very diligent in your terminology and make sure you're being very precise with it. Make sure you're not getting those terms flipped around, right? It's very important. Now, once we've gotten our contribution margin, we now need to back out our other costs, which would in this case be our fixed expenses. So 4.5 million is our fixed selling and admin, simply coming from above. And then of course, our fixed overhead of 6.3 million coming from above as well. So 4.5 plus 6.3 is 10.8. And then 15,775,000 minus 10.8 is 4,975,000. And that is our net income. So that is the first part of this question. Now, moving on to requirement 2, we're going to do the same exact thing with the same exact information. The difference being that in this case, we are using absorption costing. So let's see how that changes things. So in this case, our sales number is going to be calculated exactly the same. In this case, our direct materials, our direct labor, our variable overhead, all of that is directly the same. The only difference is now we are considering the entirety of those fixed overhead costs. So we come up here and we see that we've got this $4.5 million. And so the way that we got that, of course, is by simply taking this $6.3 million that we have right here as our total fixed overhead, so $6,300,000, dividing that by our total number of units produced, and that gives us a fixed overhead rate of $60 per unit. Now, once we have that rate, we simply take that rate of $60 times the number of units that were actually sold, and that gives us $4,500,000. So this is how we calculated the 4.5 million that you see below. This is where this 4.5 comes from. It's from this calculation here. Now that we've done that, we can now come in and simply add up these four numbers. That gives us 15 million. And then we take 27 million minus 15 million, and that gives us $12 million for gross margin. Now, once we've done that, we are simply ready to deal with our selling and admin. So we simply come up, we find our 4.5 million in fixed selling and admin, our 725 in variable selling and admin, back those two out. And that gives us this difference, or I'm sorry, it gives us this sum of 5,225,000. We then simply take the difference between the 5,225,000 and the 12 million to get us net income of 6,775,000. Now the question is, before we did all this math, if I had just asked you, given the information above, which method will give me a higher number for net income, you could have answered that question without even having to prepare either one of these financial statements, certainly without preparing both. And the way that you could have done that is by understanding the general relationship between these items. So that's what we're going to cover now. So I'm just going to type this out over here. We've got three situations essentially. The first situation is whenever production is equal to sales. So when production equals sales, the following is true. When production is greater than sales, the following is true. And then of course, the last situation would be when production is less than sales. The following is true. So this is what we are looking at in this case, these three situations. So when production equals sales, then net income is the same. So net income under absorption equals net income under variable. But you'll notice in this case, our production was 105,000 units. Our sales were only 75,000. So those two numbers weren't equal. And so what we find is that our net income will not be equal. And that's what we ended up with, right? We actually ended up seeing a difference in this case of, I believe it was $1.8 million. So we could have certainly forecasted there being a change in the income, even with just this first rule, even if we didn't know the next two, because we realized that the production level was different than the sales level. And if those two numbers are not the same, we will end up with different answers. So that's our first piece. Now, our next piece is when production is greater than sales. When production is greater than sales, absorption income is greater than variable income. So absorption income is greater than variable income. And when production is less than sales, absorption is less than variable income. Less than variable income. Okay, very good. Very good. Now, this is important because what we need to realize is that it would be very possible for me to give you several questions on something like the exam where I don't even expect you to actually do all of the math like we've done here. I simply give you this table and I say something like, given what we know about how these two methods operate, can you discern which method would lead to a higher reported net income this period? And could you go through the process of preparing a full-blown variable income statement and then a full-blown absorption costing income statement and compare the two? Of course you could, but you may not have the time to do that on an exam. So you would need to realize what these relationships are, and then you would be able to answer the question much more easily. So let's see if this holds with what we did here. So we said in this case, units produced 105, units sold 75. So production greater than sales, this is the case we're looking at. And we said absorption income should be greater than variable income. Let's see if that's true. Oh, this is my absorption costing income statement. Net income, 6,775,000. Is that greater than 4,975,000? I believe that it is. I believe that it is. And so we can see exactly that that rule did hold. Now, the only question is, why is the difference what it is, right? Why is that difference 1.8 million and not something else? Well, what's the only difference in how we compute net income under these two methods? It's the treatment of what item. Okay, so I'll give you just a second to think about that. So the difference in the two methods relies solely in the treatment of fixed overhead. So the difference between calculating net income under absorption costing and variable costing lies only in the treatment of fixed overhead. That's it. That is the only difference, is how we treat that fixed overhead. So could we calculate this difference by looking at how we treated the fixed overhead? So we saw before that we were allocating $60 per unit in fixed overhead. If you want to see that calculation, just rewind the video a couple of minutes and you'll find where I walked you through that, right? But it's the 6.3 million over the 105,000, and that's where we got the $60 per unit. Now, that on its own is not enough, right? We're certainly off in our income by more than $60. But notice that is $60 on a per unit basis. And what was the difference in my production level? Well, I believe my production level was 105,000, while my sales level was 75,000. And of course, all of this is in units. So we'll go back and we'll correct our units real quick. And whenever I do that, whenever I do this math, $60 per unit times the difference between 105 and 75, what I end up with is $60 per unit times 30,000 units, which equals $1,800,000. Now that 1,800,000 is the difference that we see whenever we compare $6,775,000 to $4,975,000. That difference, 1.8 million. So we've now explained the difference between these two methods, right? It is entirely because of how we treat that fixed overhead. That is the only change, is that treatment of fixed overhead. And you can see the dramatic impact that it can make whenever we're actually looking at net income. Now, what does this tell us on a more broad scale? Well, this tells me if I'm evaluating my management and I'm doing it with an absorption costing income statement, I can probably manipulate that pretty easily, right? If you tell me I need to hit a certain amount of net income, well, what I can do if I'm not the most honest, the most reliable manager, is I can just ramp up production. Because by ramping up production, I'm going to drive down that fixed overhead assignment on a per unit basis. And then it's only moving from the balance sheet to cost of goods sold on the income statement when the actual sale occurs, which means in that interim, in that period of time where this item is built but not sold, that cost has been deferred as an asset on the balance sheet and inventory under absorption. Under variable, that cost is expensed right away. So what we find is that if I'm actually making internal promotion and management decisions, I'm deciding who to raise, who to give a raise to, who to promote, I'm looking at people that need to be terminated, whatever it is, if I'm looking at some type of decision on the internal side, then I'm almost always going to be better off by doing this analysis under variable costing, because variable costing cannot be fooled. Variable costing says the only way for you to increase your income is for you to actually increase your income by either cutting cost or increasing sales. And you say, well, that sounds great. Why don't we always just use variable costing? And the issue is, well, variable costing doesn't follow the guidelines set by US GAAP, which means it cannot be used for external financial reporting, which means if I'm using variable costing for internal reporting and analysis, I'm going to have to make some adjustments at the end to get back to absorption numbers to actually deal with my audit, to actually publish my publicly available financial statements. So there are some issues with using it, right? It does create a little bit more work, but you get much more useful information out of that variable costing income statement because it cannot be fooled as easily as the absorption costing income statement. And this is something that we will discuss at length in class. This is something that you will see over and over and over in this homework assignment and as you read through the chapter and in the lectures. So this is not something that's just coming up one time here. It's a major theme in the chapter. And it's absolutely crucial that you understand it if you want to be successful here in chapter 19. So if you need to rewind it, if you need to come by my office, send me an email, talk about it, do that, right? Make sure you understand this relationship between absorption and variable. Which one will give you higher income, which one will give you lower income, in which period, why that is, how all of this works, where the costs are stored temporarily under absorption. You need to know all of that to really have a good understanding of this chapter. Very good. So with that discussion had, we can go ahead and move on. So we'll wipe out this page and move on to number 4. Now, here in number 4, we are looking at a variable costing income statement. So we've done this, of course, before. We just did one of these, but here we go. So in this case, they say, we are dealing with a kayak company, Kinsey Kayaking. They are, of course, a manufacturer of kayaks, and they began operations in the current year. During the first year, the company produced 1,025 kayaks and sold 775 kayaks at a price of $1,025 a piece. Now, before we do anything else, right, before I even read that second sentence, if I'm doing this homework assignment, right, or that third sentence, if I'm doing this homework assignment, if this is a test question that I've been given, the first thing I'm going to do is as I read through this, I'm going to say, all right, we produced 1,025 kayaks. We sold 775. So the first thing that I recommend doing is as you come through this, just write down production greater than sales, which means absorption income should be greater than variable, right? Is that going to play a part in this question? Is that what they're wanting? I have no idea, right? I haven't read the rest of the question, but it doesn't even matter because what I need to do is get used to this relationship, right? And the more I write that, the more I'm going to remember it. The more I say that, the more I'm going to remember it. And the more able I'm going to be to use that information in this question and future questions, right? So take the 2 or 3 seconds, write that sentence down. Production greater than sales means absorption income greater than variable income. That's what we need to understand, right? That's a great starting point. It gives us a kind of a free win on the question. It's something that we can certainly just memorize and have it to use. So go ahead, start off there. Now let's see what it tells us. At the first year end, the company reported the following income statement information using absorption costing. So we've been given that up top. So this is more or less our absorption costing income statement, right? It's a little bit more abbreviated than the way that we did one on the previous question, but it's fine, right? It's got all the key components. It's got sales, cost of goods sold, gross margin, all of our other expenses, and then all the way down to net income. So it looks fairly complete. And what they say now is, we got some extra information. So product cost per kayak is $400. This is $300 in variable production costs and $100 in fixed production costs. I wonder if that's going to matter. I don't know. We'll see in a bit. The latter amount is based on $102,500 of fixed production costs allocated to the 1,025 kayaks. So this is just simply some division. 102,500 over 102,000. I'm sorry, over the 1,025, right? So it's just the 102,500 divided by the 1,025. And then, of course, that gives you the $100 per kayak. So that's what part A tells us. Part B says the $230,000 in selling and admin expense, that consists of 95 that is variable and 135 that is fixed. So if I were doing this on the test, I would just make a note, something like this, and I would say, all right, we've got 95,000 of this. Right? This is, of course, variable. I do apologize. Trying to write with a mouse, still not something I'm very good at. But this is what we have. 95,000 in variable, 135,000 in fixed. So we've got this right here. We've got that split. That split is going to be important to us in a minute. So it's important that we do not forget it. All right, if you would rather just do something like highlight this 95 variable, 135 fixed, that's fine. But to me, just taking the time to just visually show that split and me actually writing it down, I'm far more likely to remember that in just a minute whenever I need it. So now that we've read the question, now we're ready to actually see what they want. Right? We've read the situation, we've analyzed it, we've done a lot of good work already. Now it's time to start putting those numbers into the actual question that we've been asked. So first, prepare an income statement for the current year under variable costing. So I say, all right, well, variable costing, which one is that? Well, variable costing is the one where we start off with sales and then we back out variable costs. So first thing I've got to do is compute sales. And of course, to compute sales, one way to do that, in this case, they actually just went ahead and gave it to us on the absorption costing income statement. So you can simply pull that down if you want, or you could recalculate it yourself. We sold 775 at a price of 1025. However you want to do it is fine, but that is where we get the 794,375. At this point, we're now ready for my variable product costs. Well, in this case, we've got to read, and it tells us that our product cost is $400 per unit. So the question is, and by far what I see a lot of students do, is they'll simply take that $400 times the 775 units, and they'll get some number, whatever that number is. But the problem with that is that right? Is that right? So I just want you to think for a second. Does that make sense, right? I'm looking for variable cost, but that tells me that the total product cost per kayak is 400, which means that some of that is not variable, or some of that is actually fixed. So this would not be correct. Instead, what we need to do is take the $300 per unit times the number of units that we actually sold. And when I do that, this is my $232,500. So do you understand why that is, though? So the issue here is, initially, when I read this, it's very tempting for me to go ahead and come in here and say, oh, what's my cost per unit is $400. Let's just pull that in. But you have to read more carefully. They then go on to tell us this is $300 in variable production costs. That's why when I'm computing my variable product costs, I use the 300. Now, once again, this is only for the units that we have sold. So I don't care about the 1025. I'm just looking at the 775. Okay, so there's the 232,500. Next, we need my variable selling and admin costs. So this was given to us. This was actually the split that we did earlier. because whenever I move the screen, the annotations don't stay in the same spot. They actually move too. I went ahead and erased that. But this is where that 95,000 is coming from. All right, they gave it to us in one of these points here. 95,000 is variable. So that is where this comes from. At this point, we've accounted for all of our variable costs. So we simply add up our variable costs. And what we find is that my total variable cost is 327,500. Subtracting that out of my sales, it gives me contribution margin of 466,875. Now, the only thing left for us to do is to actually deal with those fixed expenses. So those fixed expenses, we know one of them is this $135,000. The other is the $102,500 that we were told here. So once I've pulled those two numbers in, I'm now able to total that up to get my total fixed expenses, $237,500. And this gives me net income of $229,375, simply being the difference between contribution margin and my fixed expenses. But the question is not done, right? This is where we would have left it on the last question, but now they're asking us to do what's called a reconciliation. So they're asking us to reconcile income, or the difference in the income between variable costing and absorption costing. So remember that piece that we did earlier when we first started the question? Right after we read that second sentence, we said, stop, we're going to write this down. So look on your paper, see if you can find them, right? What we said at that point was that we noticed that production was greater than sales, which means that absorption income should be greater than variable income. So now let's look. We've got variable income, $229,375. We've got absorption income, $254,375. So sure enough, absorption was greater. So we feel like we've done this correctly. And that difference is $25,000. But much like we did on the last question, I want to see if we can figure out why that $25,000 is the amount. Well, what we find is that the number of units that we're actually dealing with here is the 1,025 units minus the 775 units. That's 250. So that is where this 250 comes from. We saw our fixed overhead cost per unit was given to us as $100 a piece. So then 250 units times $100 per unit, there is my $25,000 difference that we're seeing. So it does reconcile, right? We can explain that difference. Now, even if this is not asked of you, I do think it's not a bad idea, especially in the homework, even if a question doesn't say like, do this particularly, I still think it's a good habit to get into, to just run yourself through that process, just to make sure you're getting comfortable with it. All right, the more times you do this, the more times you see this, the more likely you are to remember it. So make sure you're doing that. Make sure you're doing it. And now this is just having you do that again, right? Just making sure that you understand what that's actually telling you. So the dollar difference in variable income and absorption income is explained by 250 units. That's the 1025 minus the 775 times the $100 in fixed overhead per unit. And so, of course, that explains the $25,000 difference. Now, number 5. Here in number 5, 6, and 7, we're going to run through with this one set of data, and then we're probably going to go ahead and stop this video. Even if it's not quite as long as I initially thought, I think I do like the idea of just kind of taking a break in the middle of this one, just to give us all kind of a spot to kind of just refresh, reset, and then begin again on the second half. And the idea being, even if you get through all of these 7 fairly quickly, it's been a lot of work, right? It's been a lot of thinking that we've been doing, a lot of analysis. Might be a good time just to get up, go take a break for a little bit, come back and knock out the last half of the homework. But in any case, let's go ahead without further ado and get into number 5. So in this case, we're dealing with Oakmark. They're a producer of solid oak tables, and they report the following data. Much like we said before, not a bad idea if you want to go ahead, take a picture of this given information, and then you'll have it as we kind of work through the next 3 problems, because all 3 are using the same set of data. So very important for us to have that, and very likely we're going to get very comfortable with this data set over the next few minutes. So we see we've been given sales price per unit, units produced, units sold, beginning inventory, etc. Now, a couple of things I want to point out before we get too far. Notice here, units produced 110, units sold 113. So as soon as I see that, hopefully the logical part of my brain says, all right, if I sold more than I produced, I've got to have something in beginning inventory. Because if I didn't, it doesn't work, right? I can't physically sell units that I haven't made yet. So hopefully the logical part of my brain says, all right, I'm looking for some more information to tell me what we began with. Thankfully, this table is set up nicely for us, and that information is given to us on the very next line. And what we find is that if I actually look at this, I'm not going to have any inventory left at the end of the year. And you say, well, how is that? Well, let's see. I've got units produced this year, 110,000. I had beginning inventory this year of 3,750. This gave me a nice title, or a nice total that we saw a lot in chapter 5 in accounting 2301. This is total goods available for sale. And this is 113,750. Then, of course, we back out the goods sold. And what we find is that we actually sold 113,750 units. So ending inventory in units is 0. So we've got no units left. Now, this is one way to look at that. This is one way to analyze that. That works perfectly fine. The other thing that you can do is, if you're more of a visual person, you can remember that back in 2301, we had this really nice chart. Oops, I got the diamond on accident instead of the rectangles, which it doesn't really matter, I guess. But back in 2301 in chapter 5, if you had me at least, you saw me draw this chart. I don't even know how many times in class, countless times. You probably got sick of it. But this is what we said. Back then we said, well, what we do is we start with beginning inventory. We add to that, so plus any purchases or production. And that gives us goods available for sale. And then that splits out into either cost of goods sold, which goes on the income statement, or ending inventory, which goes on the balance sheet. So what we said was then, and let me grab our arrows. So we said these two come down to give you goods available for sale. And this number splits out into two components right there. And then of course, these two should add back to give you this. So if we just drop in our numbers, in this case, we had beginning inventory in units, 3,750. We produced 110,000. So 110,000. That gave us goods available, 113,750. We sold 113,750. And so of course that leaves nothing in ending inventory. So the point here is, I don't care how you think about this. If you really like that chart that we used back in 2301, pull it out again, use it again, right? I'm an extremely visual learner. For me, if I can see it in a picture, that makes it so much easier for me to remember than just seeing it in a formula, right? Formulas are excellent. They're great. They speed up our lives. They make things easy. They make things automatic. We like formulas, but sometimes it's just easier to remember something with a picture. So if you're more of a visual learner, if you understand more by seeing a picture, then use the second method that we just went through to realize that ending inventory is just nothing in this case, right? If you can just look at that and see it just from the information, the way it's presented, then that's fine too. But I think it's worth taking a few seconds and either drawing a picture, writing out the formula, and doing something so that you see exactly what you're dealing with. So you don't accidentally get a sign flip, so you don't accidentally misinterpret something. You take the time, you're very diligent, and you make sure that you're not making a careless mistake. Because I'll tell you, it's the little stuff on the test. It's the little stuff on the homework they cost people the most points. They cost people the most points every semester. If you do a little bit worse on an exam than you really wanted to, 9 times out of 10, it's not that you didn't know the information. It's that you got in a hurry and you made a silly mistake, or that you just forgot something that you do know. You just couldn't grab it at the exact second that you needed it on the test because you didn't really have it committed quite as well as you thought you did to memory. And so the way that I think about even just simple stuff like this is not like it's so easy, we've got to rush through it, right? Don't ever take that approach. If you take that approach, all you're going to do is end up taking longer later or making a silly mistake now. Instead, whenever you see something nice and easy like this, where you say, oh, okay, well, let's just figure out how much we've got left in ending inventory. It's a good starting point. Your thought process should be, I can't afford to go too fast, right? I cannot afford to rush through this and make a silly mistake. Because if I do that, if I mess up the easy thing, then it's going to trickle down and mess up the harder stuff later. So when we find these easy things, these things that we can just figure out in just a few seconds, take advantage of that, but make sure you get it right. Right? Don't go, oh my gosh, I've got to rush through this, because that just leads to careless errors. Right? That just leads to silly mistakes. So then when you come look at your test or you come look at your homework in my office with me, you're going to be upset with yourself because you're going to say, man, I knew that. I knew that. What happened? And the answer is, well, you probably just got in a rush, right? You probably just got in a rush. And so that led to some issues. So do keep that in mind and do make sure you take your time and get these things correct. Very good. So with that, I'm going to go ahead and clear all this, and we're going to go ahead and continue down. We then see we've got some information about our beginning inventory. We've got some variable and fixed. We've got our current year costs. We've got our fixed overhead, our variable overhead, and then of course our fixed and variable selling and admin. So in this case, what we're going to be doing, we're going to be starting off with a variable costing income statement here in number 5 with this information. Then in number 6, of course, we'll be switching that over to the absorption costing. And then in number 7, we'll be doing a comparison. So that's kind of the remaining portion of this video, those 3 things. So here in number 5, let's go ahead and get started. So in number 5, we want to prepare the current year income statement for the company using variable costing. So hopefully while we were up top, you got that picture taken. If not, just rewind the video a little bit, hop back, take a picture of that, and we'll go ahead and get started. So in this case, we needed our sales. So for our sales, we simply take the number of units that we actually sold, in this case, 113,750 times our selling price of $320. So whenever I take 113,750 times 320, I will come out to $36,400,000, and that is what we see here. So we've now taken care of our top number. Our beginning part of our variable costing income statement is, of course, done at this point. Now, the next thing is we've got to remember, of course, this is a variable costing income statement. So instead of taking out cost of goods sold as that next item, like we got really accustomed to, where it just became automatic in 2301, we've got to remember, wait a second, this isn't absorption. This is variable, which means I take out variable cost. So what I'll do, I'll pop back up top. I'll find that they gave me beginning inventory had variable costs of $525,000. So here's that information. So we just pull that straight in. And then of course they tell us we incurred some manufacturing costs this year. So for direct materials, they told us a per unit cost here was $44. So we'll take that 44 times the number of units that we actually produced this year, 110,000, and that's where the 4,840,000 comes from. For the 7,040,000, this is the $64 per unit times the 110,000, and that is 7,040,000. For the variable overhead, with the variable overhead, that piece is just given to us. It is $3.2 million, so that was nice. And because we're doing variable costing, we're done at that point for this section. If this was absorption costing, we would need to consider the fixed overhead piece, but it's not. This is variable. So at this point, we simply add these numbers up. So whenever I come in and I add up this section right here, what I end up with is $15,605,000. So if you want, you can just kind of give yourself a sum symbol, right? The Greek sigma, so that you know, hey, this is just the summation of these 4 numbers. It gives us the $15,605,000. Now, because we did all that work earlier on determining that we had no units left in ending inventory, that makes this next line extremely easy. If there's no units in ending inventory, well, there's no dollars in ending inventory either. So that just becomes a 0. All right, so because we took the time earlier to get our facts straight, to analyze the question, think ahead, hey, where might this question be leading me? Hey, what might I need in a little bit? Because we already did all that, I'm done at this point, right? I don't have to go back and think, well, all right, what is the number that goes here? I know there's no units. If there's no units, there's no dollars, right? So that's just a 0. And so that makes our variable cost of goods sold equal to our total variable costs available, right? Just the 15,605,000. And then of course, we will add in our variable selling and admin, which is just given to us, $1.3 million right here. So we'll simply grab that number, drop it in, and that gives us total variable cost of 16.9 million. We now subtract the 16.9 million from our 36.4, getting us to 19,495,000. So just to be clear, this is 16,905,000 in variable costs that we're subtracting, not just 16.9. So do keep that in mind. But that is this 19,495,000 for contribution margin. Now, whenever we're preparing our variable cost and income statement, we start with sales, we then back out variable, then we back out whatever's left. And whatever's left, if we've already dealt with the variable, it's our fixed. And in this case, we were given our fixed selling and admin and our fixed overhead. So here's our fixed overhead, 7.4, our fixed selling and admin, 4.2. And whenever I deal with that, that gives me 11.6 million for total fixed. Backing the 11,600,000 out of my 19,495,000, that leaves me then with net income of $7,895,000. $7,895,000. And of course, we are done. Now, the only thing left for us to think about at this point, before we continue on, is, well, what do I expect the relationship to be, right? So we just did all this work for variable costing. Before I do my absorption costing income statement, maybe I should think about what I expect that income number to actually be. So under absorption costing, what do you think? Do you think absorption costing income will be greater than 7,895,000 or less than 7,895,000? So I'll give you a second, kind of think that through, and then I'll explain why it is what it is in just a moment. I want to give you just a second as you watch us to kind of consider what we're about to do and think, which one should give me greater income? So now that you've had a second to think that over, what we find here is that we just go back to the relationship we talked about before. And that relationship was that if units produced is greater than units sold, we have one outcome. And if units produced is less than units sold, we have another outcome. And then of course, if units produced and sold are equal, we have the first outcome that we talked about originally. But because that's not the case here, I'm just leaving it off. So now we look at what we've been given. Which of those two is true? Units produced was 110. Units sold was 113, 750. So which one is true? Well, I think it's true that units produced is less than units sold. And if units produced is less than units sold, what we saw was that absorption income should be less than variable income. So before I do any numbers, before I enter anything in my absorption costing income statement, in the back of my mind, what I should be thinking is, hey, when I finish this, when I get to the end of absorption costing, that net income number should be less than 7,895,000. Now, could I go ahead and figure out what that number is? Yes, I could jump straight to that. I'll show you that after we get done. But I should know for sure absorption will be less than variable. If I get to the end and I find that that's not happening, then I know I've made a mistake somewhere along the way, because this is what the rule says. If units produced, in this case, 110,000, is less than units sold, in this case, 113,750, then absorption income is less than variable income. And that will always be true. So with that going forward, we'll now go ahead and start on our absorption costing. So here we go. So right off the bat, sales is going to be computed the exact same way it was before. So I'm not going to go over that again. If you want to see that, just rewind the video a couple of minutes and we've got that for you. And then of course, we've got to take out cost of goods sold. So we went through the pictorial representation of how to compute cost of goods sold a second ago. Now we're just going to go through it with the actual income statement, with the formula-based approach, because that's what we're seeing here. But we start off with beginning inventory. So we just come back up top. We find our beginning inventory, 806,250. So that's going to be where we begin. So if you're looking at the picture, beginning inventory plus either purchases or production in the current period. Well, what costs get added to inventory under absorption? Oh, wait, I think it's those four things that we keep seeing: direct materials, direct labor, variable overhead, and fixed overhead. So that's our next four lines. Direct materials, 4,840,000. Direct labor, the 7,040,000, the variable overhead, the 3.2, all that's the same. And then the fixed overhead of 7.4 million, of course, being given to us here. So with all of that, we are now able to finish off this section. Much like before, it's the same data set. So we know that we've got no ending inventory. So that number is, of course, 0. So now at this point, we just add up everything that we see there, and we come out to cost of goods sold of 23,286,250. Subtracting that out of our 36,400,000 gives us 13,113,750. We now deal with our selling, general, and admin, or our SG&A expenses. And in this case, that was given to us as 4.2 and 1.3 million respectively. And so that gives us a total of 5.5 million, giving us net income in this case of 7,613,750. Now, let's just think real quick. Before we started this, we said absorption should be less than variable. Absorption, 7,613,750. I do believe that is less than 7,895,000. But now the question is, well, what explains that difference? So the difference, right, is 281,250. You get that by just punching the two numbers in the calculator. But the explanation is the difference, right? Originally, we had 3,750 units in inventory. Now we've got nothing. So that difference, that change in inventory was 3,750. And then the fixed overhead that we assigned per unit was $75 a piece. And that, I believe, was given to us up top. Let's see. The fixed overhead on a per unit basis. And of course, we see that given to us right here, where it says in our beginning inventory cost, we had fixed, and this was the $75. So that's, of course, where this is coming from. And in fact, you notice that the amount we ended up being off by was the 281,250. And so what we're seeing here is even a clearer representation than what we saw before, where truly the only difference is in how this gets represented on the balance sheet. So you can see that under absorption costing, originally, we had this 281,250 stored on the balance sheet. But then in the year that we actually sold everything, we ended up having to pull through this extra 281,250 as an expense. Whereas under variable costing, that would have been dealt with in the prior year. So that's the issue here. And that is why we were actually able to show that difference as 281,250. And then, of course, the very last piece here is just making sure that we once again understand that where that is coming from. And that is what we see right there. So very good. So with this done, we now see that we have completed the first half of this homework assignment, and we are ready to move on to the second half. So I'm going to go ahead and wrap up this video here, and I'll see y'all in the next one. Thank you.